There's a very sort of stability-orientated view. Give me yours. I mean, Ed, being very concerned that it is reminiscent of the 1990s, yet everybody comes in here and they tell me the earnings will sustain and maintain the drive higher in stocks.
Yes, I mean, we are sort of have a more balanced view right now on the markets. I mean, coming into the year, we were quite constructive on markets, and markets has been performing better than our expectations. I mean, already at our year-end price target. So it does suggest that there's a certain level of productivity increases that's being priced into the market given where valuation measures are. But that said, the economy does remain in good shape, and earnings revisions are happening. It also suggests to us that, with this economy continuing to chug along and financial conditions are likely to ease further, the Fed has already hinted that there are interest rate cuts on the horizon. It feels like the path of least resistance for stock is up. And then you have, a pretty low volatility environment, both from an equity standpoint and a bond standpoint. So it does suggest that that supports risk on, and there are dip buyers in the market. And so it feels that even if we do get some kind of consolidation from here, that it's likely not to last for very long, nor be very deep.
I was reading Torsten Slok's research this morning. He talks about sticky wage inflation. The New York Fed, this was actually quite shocking. The New York Fed model has 5% on wage inflation. That is a country mile, or in American speak, that's 3% away from the target. So, Nadia, when you look at the break-evens, when you look at the Fed model when you look at the New York Fed model on wages, are you still convinced that we get 3?
I think so. I mean, our core view is that we get 3 cuts this year starting in June, and that's sort of been our core view since late last year. It depends on which sort of wage growth measure you look at it, because, ECI is suggesting a different number, that you're closer to that 3.5% that the Fed wants to see wage growth that's consistent with its 2% target. But I think, as Chairman Powell noted last week, there are going to be bumps along the way, but our core view, as long as inflation remains on the path back towards 2% over the projection period, that's what's really important for the Fed. And, the fact that they did revise up their core PCE number while still maintaining 3 cuts does suggest that the Fed is willing to tolerate a bit of a volatility around inflation, and the Fed wants to cut and really stick that soft landing that's within sight. I mean, the fact that you have core PCE for this year and their projection at 2.6, that's not far off from, the 2.8 measurement that we got recently in our expectations for this Friday. We know that the Fed put is in play, and so that should be supportive for markets, and, rates volatility is coming down, and so that does provide a floor for equities in our view.
That's the holy grail, really, isn't it, Nadia, for this market, in that the expansion in profits, the expansion in markets, and yet people have said to me, as far as AI is concerned, Europe and the rest of the world is in the foothills of electricity use and data use relative to the US.
Yes, I mean, sort of our view in terms of, I agree with Cameron in terms of the cyclical recovery that's happening. This is one of the reasons why we've been favoring industrials, and we're seeing an improvement in breadth. You do have nearly 80% of the S&P 500 companies now that are above their, 50-day moving average. In terms of sort of like the expectations around AI and data and electricity, the infrastructure continues to be built out for AI. There's more to do, of course, in terms of on the utility standpoint. You're seeing some opportunities there as well. We continue to like tech because of this. We have some selectivity within utilities. Overall, we are underweight utilities, just given the fact of the defensive exposure in this sector. But we do think that there are opportunities from those that could benefit from the continued pickup in data centers and AI. I would say, just to finally send home that point, our focus in tech also has expanded beyond the U.S. We have been encouraging our clients to also look outside the United States, particularly in Asia. Asia Super 8 is a group of stocks that we are looking at in terms of exposure to AI from a semiconductor standpoint, as well as an AI application standpoint.